Good morning, everybody. It is May 15th, 2020, and we are going to go through some things with the economy today and some investing ideas for coming out of this down the road. Going to cover the good, the bad, and the ugly, and we're going to do it in about 30 minutes. So the newer format is 30-minute webinars for fundamental trends, seeking alphas, margin of safety investing, which I run, and my investment firm, Blue Mound Asset Management, which is open for business again. I hadn't been taking clients for a while, but I have decided to do that, given that I'm partnering with a couple of other people to help me take on that workload. So, a lot going on. The economy is reopening, but it's not really open. So we're going to talk about that, and then off of the air, we will do a question and answer with the members that I will post separately. So if you have any questions in the future, I recommend that you use the Ask Me Anything threads with the investment letters, or if you like, go ahead and send me an email if you got that. But I think the Ask Me Anything threads are the best spots. And away we go. So, there's been a lot of angst, a lot of debate about whether or not we should reopen the economy. And, the phase one, I believe, is going to end up being something that sticks with us relatively long term. I don't see the phase two reopening happening until maybe next spring. By then, we should have good antivirals. And maybe even good news on a vaccine going to production. So let's take a look at where we're at. This is a presentation that I've updated from a few weeks ago. And this one, if you'd like to give this one to friends, go ahead. I know a few people asked me about the last one, but that had all of our stock picks in it, and I did not want to give those away to the public for free. These ETF picks that we have in here, those are, I think, very good for building an asset allocation. There's going to be other ones that we use, but these are some good cores. The charts are not updated, so if you want updated charts, you'll need to be a member. And all of my services right now, through Memorial Day, I will give you for half price for the first year. So, for a couple of $100 a year in most cases, you can have what I think is pretty top-notch research that I've been partnering with some of the best and most successful people in the country right now. So we really have an under-the-radar service, but our numbers are growing. 350 subscribers paid, and well over 1,000 people getting the monthly newsletter. So I think that this is probably a good place as any to take a look at the bad news. The path forward from coronavirus is going to look something like this, I believe. We're going to continue to have a lot of economic destruction this year. By next year, it'll just be lingering economic weakness as the bottoms are all put in and things start to work in the right direction. And by 2022, I do think the economy starts to work its way back to the 2019 levels. So in 2020, we're going to see a 15 to 20% drop in GDP. I originally forecast 15% when everybody else was saying 8, 9, 10, 11. And I will stretch it out to about 20% based on what I'm seeing right now. And we're just going to go through some headlines because I didn't get all the charts in. But this presentation will have all the new charts by this weekend. By 2022, that'd be the year that I guess we get back to 2019 GDP. That probably doesn't reflect itself in corporate earnings because a lot of corporations are taking on debt and are going to have to deal with massive structural changes in the economy as we are seeing company after company are announcing that the work at home approach is going to stick. So where are we on coronavirus? This is a chart from a few weeks ago that showed that New York and New Jersey, and then some of these states in this L shape here were dominating the deaths from coronavirus. New York, and this is an updated chart, has seen the number of deaths by day go down dramatically. So just a few hundred per day. And hopefully they can get this all the way down to a 2-digit number quickly. I think they're on the verge of that. I want to say that this is like 100 and this one's about 165, the last one. So, New York is making great progress. This is what the deaths look like now. States that were in proximity to New York, had the worst experience. Connecticut, New Jersey, Massachusetts. And having made this drive over and over again from New York out to the East Coast, you can notice basically this runs along Highway 94, 90, across these states. California has a little bit of an uptick, which I think, was to be expected. I'm actually surprised that California has done this well. They've been among the most strict with lockdowns. So you can see that a lot of these other states are starting to become a bigger share, right? Little boxes now becoming a bigger share as the states move into phase 1 of the reopening, which again, I think was probably anywhere from a month to 2 months too early, but it's done and it's probably going to stick unless we have a horrible second wave that requires, the government to just say, look, everybody go home. We're passing a law. You're all going to get money for 12 weeks. Go sit at home. I think that's the worst case scenario. We can afford to do it if we have to. So that is the thing that I would tell you to keep out hope on is if we get a second wave that is more severe than we expect, and we have to do another mass national shutdown, that would probably be about a 12-week thing. We can afford the $3 or $4 trillion to do that. At this point, we're printing money like it's Doritos. It's just at some point you just make the quantitative decision, say, look, everybody go home. The supply chain is good enough. We'll stick to essentials, and everybody's rent is paid. Everybody's mortgage is paid. Everybody's got food. Go home and binge watch whatever it is you want to watch. I don't know that we'll get to that point. It is clearly a concern of mine. If we did get to that point, obviously there's side effects to that financial monetary medicine. So the bad news is we really haven't bent the number of deaths daily down quite yet, all the way as low as we'd like to. There is progress though. You can kind of see from this chart that the inflection is starting to bend over to the right. The worry is that you get another one of these periods where the inflection is back up. So hopefully this flattens out to the point where literally we have under 1,000 deaths per day soon across the country. And I think once the number gets into just a few hundred, and I hate to say just a few hundred, but once it gets down into those lower hundreds where it's scarce state to state, I think that, would be okay. I'll give you an example. Wisconsin has been stuck at 8, 9, 10 deaths a day for a little over 2 weeks, I think going on 3 weeks now. So, we need to get that down even further. The other thing that, you may have noticed in the news is that children and young adults are being affected by this more. They're not dying but they are having significant lingering health impacts that we don't know yet whether or not will be permanent. And that's something that, the unknowns with coronavirus are so big that, I would prefer to err on the side of extending the lockdowns. Governments didn't decide to do that. I'm afraid that there's a lot of people who end up having lingering problems from this. I'm going to say stay socially distanced probably for the better part of another year. And I think that a lot of other people will too, based on the polls that are out there. This is some CDC data. It's a little out of date, but we do know, because many people died at home, because many people never made it for treatment for other things, and because nursing home deaths were not early in the early phases attributed to coronavirus, we do know that the early data suggests that through about the end of April, coronavirus death toll was underestimated by about 50%. That's probably down to around 30% right now with the updates. I just haven't updated this chart yet, but I will show you some of the sources for this information. These are great databases run by a wide group of professionals that I think is pretty credible. And again, the CDC is what's suggesting this, and I don't think anybody could, accuse them of being aligned politically all that much. And I think that there's some couching of the things that go on being said, but ultimately they're just presenting the data. Can't really fudge the data too much. This is from the MIT project on COVID-19, uses machine learning, and this is what has been the most accurate so far. And what they are projecting is that we're going to get up to near 200,000 deaths sometime in August. They're saying August 4th. I originally was thinking 150,000 deaths. They're saying 190. And ultimately, by the end of the year, we'll be over 200,000. And I think we'll probably be approaching 300,000. If the second wave is severe going into the autumn, it could be worse. So we need to be very diligent about the face masks. For anybody out there who doesn't quite understand the whole face mask thing yet, the mask isn't to prevent you from catching coronavirus. It's if you're a carrier and you don't know it, or if you do know it, that you don't, pass it to other people by coughing and sneezing. Hopefully, most of your liquids are captured by your mask. So, there's an example online right now that is a little vulgar, so I won't go into it, but it has to do with, wearing pants, not wearing pants, and standing next to somebody when you have to use, when you have to go to the restroom. So, the masks are there to protect other people. So if we all are diligent about protecting other people, ultimately we're protecting ourselves. I will say, I've been looking for N95 masks for months now, for 2 months. And last night I ended up on the 3M website and a couple of medical suppliers, a couple of industrial suppliers, and McKesson. And it is very, very difficult to get N95 masks still. And who would want those? Well, my daughter works in a salon, and I would think that you'd want the majority of the people working in the salon to have N95 masks, because if a spreader comes there and gets them sick, then they become a spreader with all those people coming through. So, if you are going to go to the hairstylist, or if you are going to go to nail tech, if you're going to go to the esthetician, I would suggest as a gift to them, if you can find one, bring them some N95, bring them an N95 mask or a few. And the people who might have them, and even though they're not always medical grade, would be your contractors, right? People who do sanding, people who, do different types of skilled work. You may be able to get one or two from them. But if you do have access to the medical grade M3s, and I believe the code is 1860, if you can find them, and they're not scarce at your local health outlet. You're in local health care. Maybe you bring that to your stylist or whoever, because I know all of our hair is getting too damn long. I'm starting to look like I did in 1986 with wrinkles, so it's not a good look. Here's what we have to worry about: researching deaths. We can see in the last few days that it ticked back up. This was good that we got under 1,000 one day, but the weekend counts are also a little bit off. So you should really take this with some smoothing over 7-day periods. And I would think that these charts based on weeks will be out soon. On the weekend, they don't get all the counts in. So you can see that pattern there. So these should be just a little lower. These should be just a little higher. So we're probably looking at about 1,500 deaths a day right now. And again, that's with New York coming down dramatically. We need this not to go up. Why? Because the economy is about confidence and finances, right? If people aren't confident that they're going to stay healthy, they're not going to go out and spend. So it doesn't matter what's open and what's not open. And that's what we really have to be watching as investors. If this economic news stays bad, and I'm sure you all saw the unemployment numbers, which actually weren't quite as bad as reported because there was an error, about a 200,000 count error out there. But it was still 2.6 million people applied for unemployment benefits, which is that number would be about 100,000 more than what economists expected. So really not that far off, 2.6 million, 2.7 million, depending on what the final numbers come in at versus the 2.5 that economists expected. The unemployment is something that we have to keep a lookout on. I think something that's not getting discussed right now that's very, very important is that with PPP, right, the Payroll Protection Act, Payroll Protection Program, in September, October, after these companies have kept people on long enough, they can start laying off and still have their loans forgiven. So they have to get past a certain date, depending on when they started, and keep people employed. But come autumn, there's going to be another wave of unemployed because the economy simply isn't going to pick up that quick, especially if we run into a second wave. That is something that I really think would hit the markets hard. So if we see unemployment stay high, and then there's another wave, a second wave of unemployment, just like a second wave of disease, if there's another second wave of unemployment, that really will probably crush the stock market. You're going to have people who are 4, 5, 6 months into being unemployed at that point. They're going to be short on money. They're going to be cashing in their 401ks. I saw it back in 2008, 9, 10. People tried not to cash in their 401ks, but 90 days out, most people were doing it. Most people can't go more than 3, 4 months without regular employment and still pay their bills. So those 401ks were, I remember it. I remember helping people getting money out of 401ks. I was trying to, finesse it so they didn't have to take everything out. And, there were a lot of people with 5-figure and low 6-figure 401ks just said, look, I got to have this money. And they took those giant tax penalties. Ultimately, to preserve those plans, to keep those people's plans intact, the government's going to have to offer something, because I don't see any other way out of that. So I have some charts I have to put in here. So we've already covered some of the things that can happen. You've seen the weakness in the euro that I talked about. The dollar shows intermittent signs of weakening just because we print a lot of money. However, the way that the balance of trade and currencies works around the world, the dollar is going to stay strong until sometime later this year, probably. And we'll see how the election turns out, but I don't even know if that matters too much. I think there's a lot of reasons lining up to think that whoever wins the election, there will be massive stimulus early next year. And that should coincide with the healthcare situation looking better. So the belief that the Fed can float the stock market, I still think is misplaced. Most of that money is going into the bond market. And we talked about the bond market this week. I have an outline article available with that'll be up tomorrow with 3 ETFs to look at and 3 mutual funds to look at for those of you who still use mutual funds or have them in your 401k. The triple B bonds, triple B corporate bonds is the sweet spot. That's where we want to buy because that is really what the Fed is focusing on. That and some fallen angels. The follow-on of that is that a lot of high yield debt ends up getting supported. And if the stock market takes a nosedive, those bonds will also get hit. But as companies recapitalize, and you're going to be blown away by how many companies go bankrupt by January, those bonds still, could become shareholders, right? Those could turn into shares as companies reorganize, which I don't think is a bad thing. If you want to get in on companies that go through bankruptcy after they go through bankruptcy, during that pessimistic period, those should be really attractive, or after massive dilutions. We know that the work at home from economy is taking off. Company after company is talking about that. Nationwide Insurance, big company, I forget how many employees, 17,000 or something, said that they're going to stick with this long term. So people are going to have a hybrid work model, which I've talked to you about weeks and weeks ago. We actually talked about it in January 1st after CES, after I was at the Consumer Electronics Show. That work at home from economy is real. It's just going to happen over the next 2 years rather than the next 10, which is the opposite. Usually we expect it to take longer than sooner once we understand what's happening. This time it's going to happen faster because this is a shock that we've never seen before. And these companies don't want to deal with any potential liabilities down the road, which Congress might alleviate them of. But they also just don't want to see their workforces decimated by disease, right? It's very expensive to train people. So they're going to protect people and say, look, we're going to use the technology that we've been investing in, and you're going to come into the office, once a week or once a month. I think that is the future of almost any job that's done on a computer and by telephone. So how low can the S&P 500 go? This is the chart from a couple of weeks ago. I haven't adjusted these levels very much, just small tweaks. I still think that the S&P 500 goes to between about 2,100 and 1,800. So around 2,000 on the S&P 500 sometime soon, I'd say before the election. And that is probably when you're going to want to be very greedy about buying things and holding your nose and getting mostly invested. I would expect that in this zone right here, between these two red lines, I get about 80% of my equity money invested. And I anticipate being about 80% in equities. So that would mean about 65% of my portfolio would be equity invested at that point. I still will have some alternative investments such as gold, and I've been looking at silver. And some of these bonds will still probably be in the portfolio at that point. Although I'm not very big on bonds long term. I think that the bond market is probably going to have a major negative cycle starting in the next several years. At some point, the stock market is going to the bond market is going to price in inflation and major devaluations that come with a normalization or partial normalization of interest rates. What do I mean by that? At some point, the Fed has to be bailed out because the Fed is bailing everybody else out, right? It's the Fed, think of it this way, the Fed is consolidating all the little bailouts that we could have done into one big bailout. So the Fed, using some treasury money, is leveraging up at 10 to 1, in going out and buying all these bonds so that companies don't go under, right? If companies don't have financing, they're screwed. So the Fed at some point will be at 10 trillion, 12 trillion in the hole, and we're just going to have to write a check out for that. Or you let it linger for 20, 30 years, which is probably the greater evil. So I think probably we print 10 to $12 trillion to bail out the Fed because the Fed bailed out everybody else. Think of it like AIG back in 2008. In 2008, the credit default swap market, which was all the insurance and all the derivative contracts out there, pretty much all flowed through AIG. That's why AIG went bankrupt, is because when the whole system came down, they were the ones holding the bag. Well, that ended up being good. It's all when you look through all the things that went down, in the Big Short, it looked like there was just one incredible salesman. But the reality is that it was really kind of encouraged by the government that AIG was the one holding all the debts and all the credit default swaps that went bad. Why? Because then the government could just go to this one entity, bail them out, and then that entity bailed everybody else out. That's sort of the role that the Fed is playing now, is they're going to be the one holding the big bag at the end, which is why, I'm not a fatalist. I don't see this long-term depression. I think the next year is going to be rough. And I think the recovery will be slow until it really accelerates. You've heard me say gradually until suddenly all sorts of times. I talked about it last year when I said, look, we're going to wake up one day and all of a sudden, the market's just going to be down 10% when we wake up. The same thing is going to happen with the economy. It's going to recover very slowly until we hit the hockey stick, maybe in 2023-ish, and it really, really takes off and goes gangbusters again. So once we get through this period with health solutions and retrenching and fixing the debt market and hopefully preventing people from getting booted out of their houses, which we did a horrible job of last time, there's lots of light at the end of the tunnel. But I do think around 2,000 on the S&P 500 is what we should be looking for. And that's when we should really get aggressive with being buyers. So the sun will come out tomorrow. That's, I forget what I said that was. This is Lake Michigan one morning. Sometimes I think this is the Atlantic Ocean or the Gulf of Mexico, but I think this one's Lake Michigan. I take most of these pictures. So ETF chart book for investing in the 2020s. Build your asset allocation around this. The current chart updates are only available to members. So these charts in here are a little bit older, a few weeks. Right now, if you subscribe to, anytime between now and Memorial Day, if you're not already a subscriber, half price for your first year, any service you pick. So whether you go to margin of safety investing, which I think is ideal for retirees and pre-retirees, or you go to fundamental trends, which I think is better for Xers and millennials who want a little bit more assertive approach and a little bit more trading, pick out a service. The fundamental trends, I'd say if you're, an Xer or a millennial, and if you're a boomer or older, I think margin of safety investing, that's really what that's geared towards. So the Invesco QQQ, we've talked about this a million times. It gets down to around 150. I think you want to be a pretty significant buyer. It only got down to 170 on the first correction. So this next one should get us down to 150. The green line is, which I've started to make all these lines solid, is our Armageddon scenario. Again, I don't think we get Armageddon just because the Fed is printing a lot of money, and I don't expect the Republicans to hold out on the new relief bill. Nancy Pelosi and the Democrats have proposed a $3 trillion relief bill to make sure the cities and states don't go bankrupt, to have another round or two of checks get mailed to everybody, make sure there's an open enrollment period for healthcare, things like that. I think that'll get negotiated with some there's going to have to be some tax breaks for business probably. So, I do actually think the payroll tax reduction for maybe through the end of the year makes a lot of sense. So we'll see if they can agree on something like that. I can't imagine they don't. It's not in anybody's best interest that they decide to all of a sudden have budget concerns. So a lot of other funds in here that you know about already. So what I really want to show you here is just some of the data sets that I use. I subscribe to NOMA, which is the biggest database out there. And, you know, there's still things I can't get, but this is probably, you know, almost anything that is publicly accessible in any way or with a cheap subscription or a licensed subscription is in here. So this is where I get a lot of my statistics. You can see some of the things I've been looking at, a lot of energy, a lot of COVID related things. I have other data sets that I'm looking for, pad districts for oil, right? This is good information. Different visualizations that I use that you'll see once in a while. This is the tracker for COVID-19. It's a day behind. What we can see is that the death rate is falling. And this is a product of having more testing, right? So more and more tests are given, and we're getting truer and truer numbers of these rates. The bottom line, though, is that this is the one that I think is most important, how many deaths per day, right? It doesn't matter if the percentages fall unless they fall to very, very low numbers. What we're going to end up finding is that about 1% of the people, plus or minus, who have COVID-19 end up dying with our healthcare system, which is, you know, top 20%, top 10%. You know, there's other, like in India, I would imagine the death rate's much higher for people who get it, but they're so spread out now because they all left the cities that maybe fewer people get it. Who knows? But you know, what we're finding is that, you know, more and more cases based on more and more tests given. And again, the thing that we should not immediately jump to is, well, everybody's going to be immune. We're finding out that's not true. We're finding out that herd immunity through getting infected is a horrible strategy because the antibodies don't fight the disease that well, and either it's lingering in people's bodies and reactivates, or just simply people can get it again fairly quickly. And certainly this has something to do with every individual's immune system. But, you know, 1% of the global population, if half of the people got infected, I mean, you're looking at, what was that, 35 million deaths? That's a lot of people to, you know, to sacrifice. So interesting stats here. This is MIT's website. They do some pretty interesting comparisons to the other popular model that's out there, IHME. IHME projected that things would be flattening by now. What we have found is that's not true. What's really going on, the yellow line there, the gold line there, is tracking pretty close to the MIT projection, which is based on machine learning. We've talked about why that is valuable, is the AI can calculate more data, faster and better than, you know, people playing with spreadsheets. New York City Health, you know, this is, you know, we can see that they've done very well lately, and hopefully this number, you know, I showed you this chart already in the presentation. Hopefully this number gets down from, so 571 a couple days ago. You know, we'd really like to see the number of deaths get down to in the dozens. And then, you know, once we have a vaccine, get it down to it being a scarce thing again. You know, something that you may not know, at this moment, and for the last few weeks, actually for about since the start of April, so about 6 weeks, COVID-19 has been the leading cause of death in America, above heart attacks and above cancer. It's a serious thing, right? So just want you to take a look at the headlines real quick. And I'll put charts in that support the whole, there's not enough confidence in staying healthy, and therefore the economy will be slow. We are seeing just some ridiculously bad numbers when it comes to consumer confidence and retail sales and industrial production. It's just unbelievably bad. Germany in a recession. All sorts of, everybody's jumping on the retail numbers and the factory data. The factory data is just really bad. So it doesn't matter if you're looking at Bloomberg or Wall Street Journal or Financial Times, everything out there is looking grim. And again, I don't think GDP gets back to the 2019 level until 2022 probably, and it could even be 2023. It depends on how fast confidence returns with healthcare solutions. Record drop in retail sales and factory output, right? Industrial production down over 10%. That's just massive. We've never seen that before, not even in the Great Recession. And by the way, we're fighting with China again. So we talked about the bond market a few days ago. That's out there. That's why we want those bond funds. Not for any more than about 20% of a portfolio if you're pre-retirement. Maybe you go up to 40% if you're retired. But in general, I'm more tied to gold because we know that the correlation to the stock market with gold is actually lower than with bonds. So with the gold and gold stocks, we are getting lower correlation, so better diversification with more upside. I mean, that's a pretty good equation. The only reason I want to be in bonds, and it's only a trade, I'm not going to stay in bonds long term, is because there is a gap, and tomorrow's article will show this. There's a gap between where the bonds got down to, but back up to their top. There's still about 10% to be made in bonds, plus collecting the coupon, maybe through the end of the year, give or take. So I think bonds can be pretty good for the next few quarters. And then after that, I really don't want anything to do with them. And this is something else that we've been talking about. Metals and mining can outperform in a post-pandemic world. We've gone through all the economic reasons. We'll go through those again in a separate presentation. But we've done well to get into the gold stocks, right? I mean, I think almost everybody is up 50%, give or take, 60%, 70%. I do think that GDX gets to about 40-ish before it stalls out. But it's already at 34, 35. I think that you can write long-term covered calls, right? Like next January, write covered calls to January and take that huge premium, write the $40 covered calls for GDX. Because if there is a sell-off between now and then, even the gold will sell off, but you'll have already basically hedged by collecting premiums, and then it'll run back up to 40 later on. So you smooth your ride by collecting that premium now and writing those calls out to January, $40. My calls are only $35 and $36. So I've capped myself pretty good. I had an older batch at 32. So I had to rejigger things to get a little bit, another 20 points of upside. I do think that there are going to be some very, very interesting plays on the stock side. There are going to be 7 or 8 companies that we can look at buying. You already know that I love Newmont. I think Newmont, because they're in the S&P 500 and get index fund money, they're going to be volatile. They'll go up and down with the index, but they'll still outperform because that money will really, really add to their their money flows for the stock. Ultimately, though, the price of gold being higher is just going to fall straight to the bottom line for profits. So I think there's a possibility that we see these gold stocks after they stall out and retrench. I think you see several more years of big gains. So I do think that gold stocks can be a teen percentage of your portfolio long term, and then you can trade around the edges. All right, that's it for today. We're going to sign off, and then we'll do a little question and answer. Everybody have a good weekend. Stay safe and do something good with the people who are close to you right now.